Is the U.S. economy as strong as it seems? And if it is, what investments stand to benefit the most? Hi, everyone. I'm Maggie Lake, and I'm talking markets today with Harry Melandri, advisor at MI2 Partners. Hi, Harry. Happy
Hi.
Friday.
Thank you, Maggie, and thanks for having me on, and happy Friday. It's great to see you again.
It's been a busy old week. Capped off with the monthly jobs number today came in way above expectations. We saw U.S. stocks rally. In fact, the last I checked, let me just pull it up again today. Yeah, they actually strengthened into the close, into a weekend, which was interesting. But the big move really came in treasuries, the 10-year knocking on 4%. Again, maybe backed off a little bit at the end, but it got awfully close to that. What did you make of this report?
Well, first of all, I was greatly gratified to get a couple of trades right, because I delta hedged some SOFR Deck 25 calls, and I have long tips which I got rid of half of, and so that's all nice, right? And I get to buy them back a little cheaper soon. But first observation. Never worry about one non-farm payroll number. They're all gerrymandered. There's massive seasonal adjustments. One number doesn't say anything much. And frankly, like 100, last time I checked, 125K was about one standard deviation. So if it's 250K, that's a two standard deviation event. That'll happen about 3 times a year. It's October. So it's just not that unusual. Doesn't prove anything. Now, the reason we care is because I was Googling the phrase, is the consumer tapped out yesterday? Have you any idea how many effing stories there are which start off with, is the consumer tapped out? Well, there's a lot of them, by the way. And frankly, there's a complete divergence of opinion on it. There's a bunch of people who think the consumer is tapped out. There's a bunch of people who think the consumer is roaring along. If you go on the 2 shopping malls, the basis of the 2 shopping malls I popped into over the last 7 days, the consumer is not tapped out, and there's not insufficient parking to crawl around a mall. And it can take you a while to find a parking space.
I like those real life channel checks.
Well, just, I don't know if that proves anything at all, but what was highly suggestive to me was the Dollar General results and a few other stores like Dollar General. So poor consumers, yeah, they're tapped out. I have no doubt in my mind, but poor consumers don't do much consuming, right? That's just one of the side effects of being poor. So it turns out that something like 50 to 60% of all US consumption is done by about 20% of US consumers. They may not be rich, but they ain't tapped out.
Yeah.
So
and its services was interesting that leisure and hospitality were where the biggest job gains were, which speaks to that mentality that people are still spending where they want to spend.
Some of that stinks of seasonal adjustment problems, because it's the kind of time of year that we'd normally expect to see seasonal jobs in hospitality kind of drop out. All those jobs on the Cape or places in holiday resorts should be closing down. And if you didn't do the hiring, then it's hard to do the firing. So it might be a seasonal adjustment issue. But, if you're crawling around Twitter or other spaces, reading what people have to say, and incidentally, a big thing happened recently. I don't know why, but Warren Mosler, who I'm a huge fan of as an announcer, he said everything he's got to say, and he's kind of quitting from regular tweeting. So when I saw that tweet, I went and looked at some of his other tweets, and he was pointing out that if you take a big broad brush, there is no evidence whatsoever of a recession yet. We're going on on slight indicators. There's a little bit out there that you could worry about, the loss of momentum in labor markets. That loss of momentum, usually like Sam Rule-esque type thoughts, when you see that, you'd normally expect it to be extended, but at the moment there's no firing. So Mosler took a look and said there's no evidence of it yet, which is kind of what you'd expect to see with a 6.5% of GDP deficit being run.
Yeah.
So if there is a recession on the horizon, it's really early in that process, and you see nothing in bankruptcies, you see nothing in most of the places you'd normally expect to see it.
Yeah.
So and my point isn't
This
that
is
there
why we
isn't.
had so many of the people who are proponents of the no landing, which if you're not on X or you kind of new to the watching this, it's kind of how people have been trying to categorize the US economy, right? I know most of you know this, that the Fed's been trying for a soft landing, right? Slowing growth, no inflation, get inflation down, that kind of happy medium, Goldilocks. Hard landing is if they crash it into recession with all the Fed rate hikes, and no landing is we're off to the races, even though the Fed just eased and, we've spent all this money. And that's what a lot of people kind of think we are. Well, the
Yeah.
people who were celebrating today, let me put it that way. The people who were celebrating today were thinking that this sort of underscores their narrative.
The jury is definitely out. And me personally, I have been like building up a PA position in SOFR calls because I want to
explain what that is. If you're catching Harry playing around in SOFR and talking about second deviation and derivatives, and Harry started out as a central banker. We'll forgive him for that, but he's also a very experienced trader and plays in markets that most of us don't touch. So this may not be a trade you can replicate, but it's important because if Harry's there, it probably means he's seeing something. So explain that a little bit, Harry.
So I'm betting on the possibility, not the probability, but the possibility, which I thought was underpriced, that rates end up shockingly close to zero by December 2025. And why would that happen? Well,
so you're betting that might happen? Did I just hear that right?
Okay. Yeah, I'm betting that might happen. And that's not because I think it's like definitely going to happen. It's just that I think I only have to pay a small amount, and if it happens, it's going to be like hitting a ridiculous win on the lottery on the machines in Las Vegas. This is like I put in a buck and I might make $250. So it's that kind of prop thing.
But you wouldn't do it if you didn't think there was no possibility. If you thought there was
well, I do think there's a possibility of it. Yes.
There you go.
I just don't think it's the most likely outcome, but it's certain. I think it's underpriced, which is why I fancied having a go at it.
Interesting. Why do you think that? Is it because everyone's just looking across and seeing strength and worried about stronger growth? And what would it take for that to happen? Maybe that's a better question. What is it? It doesn't seem like it'd be anything good.
So you asked me to prepare 3 what ifs. So this is one of the what ifs.
Okay, yeah, I'm going in. So if you saw my post on X today, I felt like there was an awful lot of noise and people bickering a bit from their different narrative perches about who was right. Part of it in the no landing camp, part of it in the bear camp. Were you wrong? You're an inflationista. I'm not, back and forth, which I understand. But I think as we all go into the weekend, I just want to know, okay, what is noise, which a lot of that was, and what's real? What do I need to be paying attention to now that the dust is settled in this? And so I was thinking about that, and I asked Harry to have a think about that and come up with 3 things that we should all be focused on. So go ahead. Is this one of them, Harry?
Focus in the back of your mind. We can all, in basketball, how you're meant to see the ball and see your man. It's that kind of thing. You should know where we are and worry about where we might go.
Right.
And just before we hop on this, I just want to say I got a lot of sympathy for those who think that there isn't. The landing may be delayed and delayed to an inconvenient degree, because if you look at real money is betting very hard on the idea we're going straight into a recession. And it wouldn't be the first time we had an ironic outcome where you get a head fake in markets and it looks stronger than you expect. Your positioning is all in on a recession and people are forced to drop those bets early. So that's one thing.
So is that what you say the real money thinks that it has been caught out by that and is now switching?
I think a lot of real money is already convinced we're going into quite a hard recession and is positioned long of bonds. That's what the Merrill Lynch flow show and fund manager survey documents suggest, the reports they produce. Maybe Bank of America, maybe showing my age by saying Merrill Lynch. But I do think a lot of real money accounts, and when I look at their kind of research, they all seem to be on that page where they say, yeah, we're going to go into a recession. The Fed's real rates are way too high. Inflation has come down.
Forever, though, right? They literally been saying this for the last couple of years.
Which is why they will eventually be right, but not necessarily at the right time. right? So if you wait long enough, I mean, I will eventually lose weight. I'm just hoping it's while I'm still alive. So, I don't dismiss. I just think there's a really solid chance that we could get an ironic outcome where the data head fakes people enough to force rates higher, and everyone's forced to puke up their positions before they show they're right. But why would I bet on zero rates in 2025? Well, one of the cognitive dissonance problems I have is I can see, it's obvious. Everyone knows that there's huge losses in commercial real estate, huge losses there. And in fact, if you were to ask me, why did Jay Powell do an extra 25 more than expected? One of the elements in it is he probably knows better than most of us how much money has been lost in commercial real estate. And, when you lose a lot of money, that can have knock-on effects on liquidity, knock-on effects on asset pricing, because people can't sell. You can't sell trash. You have to sell something which has value. So somewhere down, and the reason we don't talk about this all the time is the people who lost money are not banks, not yet anyway. So in many cases, the people who lost money are, say, insurance companies in their fixed income portfolios, and it hasn't been recognized yet, or it's endowments. I'd say the interesting thing about this particular moment in time is the Swensen model for endowment investing kind of looks a little discredited. A lot of stuff that Mr. Swensen got people to do isn't working out so well. And that kind of happens when you persuade enough people to adopt your model. Once you get everybody saying, oh yeah, we need to own forestry, and everyone says, oh yeah, we need to own a lot of private credit markets can start to smell a bit bad. That can happen. So there's that.
So
and then there's private equity.
We were talking about this a lot when the Fed was hiking, but it kind of fell off the radar. So interesting that you're putting it back on, this idea that extend and pretend, and that there is a blow up, but it just hasn't leaked out into any other there's basically no contagion because it's being held in the private market. No contagion yet.
Yeah, but the Fed will be more aware than we will be of how big those losses are, and big enough. If they're big enough, they'll cause problems. And that's the thing. If you cut rates,
will they though? Will they if there's because it's like pensions and insurance companies. It'll eventually leak into the system. It's not just rich folks who are going to get screwed. So
I have hedge fund manager friends, people who do asset raising, and it's maybe it's hard to be sympathetic towards hedge fund managers. But it's not a great environment to raise money. It's been tough. And one of the reasons for that is if you go to an endowment and say, why didn't you add an extra $250 million to your allocation to emerging markets? They'll say, well, you've done okay, but we haven't had a private equity liquidity event for 3 years. So we had penciled in a certain amount of cash coming back to us from our private equity, and it just hasn't happened. So we just don't have the liquidity to increase allocations to stuff that isn't core right now. So that's one thing.
So it's tied up. It's money that's tied up.
Yeah, and if you
stranded assets, basically.
Exactly, and frankly, of questionable value. We don't know what the value of these things. They can market wherever they like, and they never have to realize that loss until they have to realize that loss.
Right.
So this is one of the reasons why it isn't like front and center of anyone's mind.
But you think that that just to tie this back to the thing that we should watch is that you think this could present problems or will be something that puts downward pressure on rates? Some
part of my thinking, and I'm a weird guy with weird ways of thinking, right? My wife tells me, I'm sure anybody else who knows me will tell you as well. But I like to try and figure out why our central banker chose to do what they chose to do. And you feed into that, because if you know why what their thinking was, if you can infer it, then you've got a good chance of working out what their next move might be or their move afterwards. And I kind of wrote a piece up, I titled it Reaction Functions, because it's not just your best guess that matters. It's like the reason I'm very careful not to annoy my wife is the odds are she won't divorce me on the spot. But if she did divorce me, that's 50% of my net worth down the loo in one quick flush. And it's just not worth it. It's just not worth it. So you have to consider the possible cost. You have to consider the risk, the probability. as well as what you think is most likely when you decide to, go out and get
Right. This falls under the category of the Fed knows something that, not that we don't know, but that just we're not focused on.
Or that they're concerned enough. Like I mentioned the elections and the politics of the situation. There, a lot of people will take a view that if the opposition candidate, the non-incumbent candidate, wins, there would be a disaster for the United States. It would certainly be a disaster for people who have been gunning for him, because from what I've read and what I hear, he doesn't. He can be a little vengeful. So it wouldn't surprise me if a lot of people's ability to spend the next 10 years not in litigation will depend on who wins this election, both ways round. If one guy loses, he's going to be facing an awful lot of lawfare. And if he wins, other people will be facing an awful lot of lawfare. That kind of risk can concentrate the mind for every civil servant involved. So it's not.
That would require an efficiency that I can't quite wrap my head around. Every time anybody mentions conspiracy, I'm like, well, I understand why you might bring that up, but it just strikes me that nothing in Washington is that it's awfully Machiavellian and has to be really executed. And I have my doubts.
I think conspiracy is a very ugly word. And I think what you should think of instead is just the wider consequences, whether a civil servant would include the wider consequences of certain events, whether they'll be in the back of their mind. And what are the consequences for
that would be imbuing them in an all, like, collectively, with an awful lot of power. Anyway, I get what you're saying. But
so I just think
we'll leave that to others.
I think there's an audience for. I talked to some other friends of mine who are much better Fed watchers than me. And if this was a black and white thing, if this was, we should definitely leave rates where they are, but we can cut them to just game an election, that would never happen. But it's not a black and white thing. It's nobody actually knows exactly what will happen. And you have to decide what is your bigger risk or your smaller risk. So at the margin, if this was your best shot of delivering 50 and keeping the markets happy through to November, or that you took a risk and the markets just caught a crab, as they say in rowing, just before the elections, why would you take that risk? What's the point? So it's just at the margin, it may matter. So
and add onto your commercial real estate. So that's point one. What else are you thinking about? By the way, before you get to that, we have a really welcome everyone in the chat. I haven't interrupted because you've all been busy wishing Christopher happy birthday. And I wasn't going to get in the way of that. But Christopher, we are so excited for you to celebrate your birthday. And like he said, it's good to outlive your rivals, which made me laugh out loud, which he often does. But they're all having fun with it. And so we hope you have a wonderful, wonderful weekend and much health to come in the next year. But okay, Harry, so what's number two?
So the big picture thing that bothers me is this question about the availability of global capital. I see.
Is this related to the repo thing I asked you about, the repo headline?
I think it's related, it's related, although I suspect the repo thing is more related to these real estate losses and the cost of capital and where rates are.
I just want to underscore my sophistication when I said the repo thing. It's obviously not a thing, but there were many headlines on which we are not going to get into the weeds on. I will get with Jeff Schneider and he can walk us through that again.
Yeah, it's a really interesting thing.
But it's when people start to worry about that, like Michael Howell and Andreas and some others who were tracking it, it's a sign that there's distress in the plumbing of the system, is how I would put it. And it's often very worrying and not good when that happens. And so when you mentioned about the access or the availability of global capital, I thought maybe that's where you were going.
So I wasn't, but it really does tie into the previous point, which is these unrealized losses sitting on various balance sheets. Those balance sheets we have no transparency to. And if you don't have transparency, the guys who've lost money may have trouble finding collateral, good collateral to post up in repo. The Fed's balance sheet has been running down. The curve isn't very steep, so it's not great to carry inventory in treasuries. All of this stuff is de-equitizing and de-liquidizing capital markets simultaneously. So,
And that's something the Fed would be aware of.
Right. So if I were Jay Powell and looking
Mm.
at the whole context of things, yeah, would I do an extra 25 just to head off any problems for the next 3 months? You may not be able to. This number we just had is the kind of thing they might have worried about.
Yeah.
If you had seen this number before, you just wouldn't, your hands would be tied. You couldn't, it would put a question mark over 25 even.
Then you really couldn't. Yeah. Then you'd really look, and by the way, you don't want to come out and say, we have to go be more aggressive because there are signs of distress in the system. I mean, that would just, you can never say that as a central banker. So they need cover.
Exactly.
Yeah.
Exactly.
Interesting.
So, but this longer, the thing, when you think about global capital, I guess you should be thinking about, like, the US has had very high rates. The high rates has pulled the dollar up, and it's been sucking in capital from all around the world. That's caused distress in emerging markets, and it's caused distress in various other corners, and it's weakened their markets relative to the US, strengthened the dollar strength, and weakened their currencies. Well, recently, if you look, you'll find that the Chinese have been forced to stimulate their economy, and that they've done things which result in them issuing bonds where they had previously issued very few bonds. And the plans are to issue like 250 billion from memory. Well, those China bonds are probably going to be there to mop up Chinese savings, excess savings. But those savings would have been part of a global pool of savings that was leaking into the US before. So
add that to Japan potentially having funds repatriate, and
exactly.
But finish that outcome for us.
Well,
less flows into developed markets, but particularly US assets.
Exactly. Well, and if you had, say, a bad equity, so you might argue that that's one of the reasons why we're seeing real yields at 2%. I spent time as a real money manager in the 90s. In that period of time, in the noughties. And, we were arguing all the time about why it was real yields were so damn low, that you couldn't get 1% or 0.5%. And usually we talked about demographics and longevity. As individual longevity increased, we had more and more demand for fixed income product, and we didn't have the product. So the stuff that real money managers and pension fund managers in particular needed was long dated real yields, and they couldn't get it at good prices because there wasn't enough issued. So the stuff traded real expensive. All of a sudden that problem went away. I guess people must be dying younger. Right? Well, maybe there's a lot more demand for capital, a lot more demand for, and they've had to allow real yields to rise substantially to satisfy that. And is it possible that problem will get worse, not better, over the next 10 years? What are the things which are causing these? Why do we have such a huge deficit in the US? Well, one of the reasons is we have military spending of about $1 trillion. Another reason we have debt service of about $1 trillion because rates are very high. Rates are high because we're sucking in capital. We also have a new industrial policy. So all these factors together, and it's not just the US, everyone has it. We have climate mitigation issues. We have to invest in hardening our infrastructure to climate. These are all huge costs. So would real yields tend to drift higher if we keep borrowing? We're not the only country that needs to do that. And I would say, yeah, maybe they do. And what you may find, the issue is not in the bond market, but in the equity market. That's because if equities start falling, people will trip over themselves to buy bonds with 2% real yields.
This is such an important point. I want to put a timestamp on that. We have a question I want to get to because often when we're all very short-sighted, right? We're kind of living in a time where it's instant, and even if you think you're a long-term investor, that probably means like a month. And everybody, no one wants to stomach that. Some of the things Harry is talking about, and I love your basketball analogy because this is not a tomorrow issue, but it could be sooner on the radar than the very long term, which we always used to talk about. This came up with my interview with Paolo Macro, and he's like, listen, I get it. This used to be a thing like, 20 years down the line, 40 years down the line, but he's getting concerned that some of these issues may rear their head in the next year or two. Not fully, but if you're trying to look out and be smart about your investments, this is why you have to put this stuff on the radar. And Harry, I know that you are, looking out at the second or third move on the chessboard. And someone just asked if you're playing chess, not checkers. And I think that's what they were referring to kind of be smart about how you want to be thinking about these things. So I just think it's really important. No one's saying this is going to happen tomorrow, but I asked Harry to cut out the noise. The noise is talking about tomorrow. This is what we want to be focused on. And then to that point, Harry, I think it was Oliver asking, is the commercial bankruptcy wave coming at the same rate that the recession always is, like 3 months away? I think maybe I just sort of indicated it's not. And I just want to put another one on that commercial real estate. Ralph asking, does Harry see any commercial real estate distress spilling over to the residential market? So what's the timing of potential problems, and does it spill over into residential?
Yeah, so me personally, I really don't like residential real estate, and some part of that might be that I'm way too long of it. It's easy to hate things you got too much of. So the
time frame on the commercial
real estate, well, it's a problem. One of the ways I think about this is you've got an unexploded bomb. The scale of that bomb is completely a function of the level of interest rates. So if the Fed wants to, Tim Geithner used the phrase back in the global financial crisis, he said foaming the runways. That's when he bailed out the banks and left the owners of real estate, the kind of poorer people who bought houses at the wrong price, stuffed. But they foamed the runways for the banks, and they did that with various support measures and cutting rates, and that kept the banks solvent when individuals were not solvent. And I wonder to what degree what you've just seen is Jay Powell foam the runway, because the scale of losses in CRE will be entirely dependent, same as the scale of losses in duration, by the way, on where rates are. So if you're at the margin, it means the front end of the curve will go lower. The question marks over global capital might mean that you put the two together and you get the mother of all curve steepness somewhere down the line. And to me, this is all a question about what we do about fiscal policy. Right now, we run these enormous deficits. The deficits are unprecedented in peacetime, although you could easily argue we're not in peacetime. That's why we've got these enormous deficits.
Yes, you could. Yeah, you're right. That's a great point.
When I talk to friends who are connected in policy-making circles, they say, you don't drain the swamp when you're up to your ass in alligators. Right now, there's more important things than addressing longer-term fiscal sustainability questions in the US. So after the election, they may decide to address questions of longer-term fiscal sustainability in the election. If the deficit starts coming down from 6.5 to 5.5, 4.5, well, it's going to be really hard to mitigate that with rate cuts. We've seen the potency of fiscal policy. Very small cuts in the deficit will cause very large amounts of pain. And in particular, if you're going to cut that deficit back because you're concerned about sustainability and concerned about the pool of global savings and attracting the pool of global savings into your economy, you're going to have to legitimize the tax system a bit. Right now, capital gains taxes are low, income taxes are high, there's very little progressivity. It occurs to, and they've already announced this, capital gains taxes get raised, right? Capital gains taxes are going up. So when I look at, if you're an equity investor and you're sitting on a whole bunch of gains from God knows way back, are you going to leave them, or are you going to choose to take some of that profit before they raise capital gains taxes? So those are some of the vulnerabilities. And for me, so there's a commercial real estate black hole. It's about $1 trillion to roll over in lending, for example. There's PE losses as well. You can't get rid of those completely, but if you cut rates 300 beeps, the losses will be much smaller, smaller. And I'm not saying they're not manageable. I'm saying with high rates, they're difficult to manage, and with lower rates, they're easier to manage. And then,
So what do you, against that backdrop and those concerns, what do you like? What looks like that? Where do you look for opportunity?
So there's a question, one of the great question, because I can talk about nonsense without giving you quantitative answers and without talking about what I like. And that which has performed for the last 30 years may not perform as well going forward. And it kind of depends how a lot of things pan out. So it's easy to like commodity-based investments because they really haven't performed. They're not expensive. I don't think even that most stocks are that expensive. Most stocks are not. And
it's funny, but every time someone talks about that kind of move away, which over the course of the last week, so many of the guests who've been on have talked about maybe this is the turn, maybe commodities look attractive, hard assets, some people like, but and sort of maybe this tech leadership, this Mag 7, that's finally over. And then what leads today is Mag 7. And NVIDIA CEO says everybody wants the chips and it flies again. You know, it's been a little bit hard. But again, maybe this is a time horizon thing.
It is a time horizon thing. I was reading the story that really caught my imagination recently was on Huawei and Huawei's attempts to produce a competitor to NVIDIA. Because, of course, the Chinese are excluded from buying NVIDIA's best chips. Those chips, for me, AI is a military story more than it is a productivity story.
Oh, I just did an interview with someone who talked a lot about that. Ian Weiner, if you guys want to check it out.
I didn't see the interview. I saw that you'd done it. I put it on my list of things to read or to watch. I've been of this opinion for a while. I've been following what's going on in Russia, Ukraine very closely. It's horrific. The new nature of war is absolutely terrifying. And frankly, we should disband the infantry because if we put people in there, they'll all get killed. It's just a terrible thing. Linking AI to drones, you can create a new way of war, which is extremely, terrifying. Absolutely terrifying. In fact, you say sci-fi, but actually I've seen videos of Russians being pursued by drones in abandoned buildings in Ukraine and having to sneak around because a drone might get them. It's a horror movie, right? But this is the direction of war, and this has been effective. This is what's worked, and it's going to work. It's not going to change. So I don't see that military spending thing changing because we're arm wrestling, and it's only a question of who we're arm wrestling with. So one of the things I wanted. Oh, you asked me what to invest in. So look. You know,
this is not. We always say this, not investing advice. I'm just asking.
It's definitely not investing advice.
His thoughts for you to take as you know.
I'm still too good looking for prison, so I'm definitely not offering investing advice. But one of the things I've and this is a joke, but in every joke there's an element of truth. When people ask me why do you have Argentinian bonds, and I have lightened up a little bit recently. But one of my answers is I believe the Argentinian bonds will converge on gilts in the credit rating because they've got a smaller deficit. And I think there's a serious point hidden in the joke there, which is if you're getting a real yield of 15% and that the country can adjust, there's a solid chance that's not a bad return. And the credit worthiness of, say, G10 countries may not be fully reflected relative to EM countries at the moment. So that's one of the stories I would tell. I'd hesitate to tell you not to own equities. I think that's daft. One of the reasons I think that's daft is, I think US equities are kind of expensive. But how many games are there to play here? If the problem is gaining future consumption, obtaining future consumption in this environment, how many vehicles are there that we can find that will give us some claim on future production? And there just aren't that many, particularly given how attractive allowing inflation will be over the next 10 years. Like the authorities have every incentive to tell us they will fight inflation forever on the beaches or whatever. But in practice, they don't. They have their incentives are to allow inflation and just for it to surprise us.
It sounds like based on some of the scenarios you laid out, they can't, right? That they're.
Yeah, I think if they reduce inflation too quickly, you will have question marks over the solvency of the state. So
given those two great choices, we kind of know what's going to happen, which is the argument of the so-called inflationistas all the time.
Absolutely. I mean, isn't this the Odyssey where Odysseus has a choice between I'm being too pretentious, aren't I?
We'll let you
Scylla
get
and
it. We'll
Charybdis.
it wouldn't be a convo without you, Harry. With that,
Yeah,
Harry.
that's right. It's Scylla and Charybdis. So we can either accept. Ultimately, we're going to have. I think they're going to choose more inflation than they're telling us right now. And that's why I tended to, especially at break evens at 2. If you're asking me to say that inflation is going to be below 2, well, A, it hasn't been, right? It really hasn't been for the last 4 years. And B, I don't know why it would ever get there. Frankly, I think 3 is the new 2. And I think Olivier Blanchard told us that in an FT op-ed a while back. So
Ralph is asking if you see other good opportunities in LATAM. And Harry's a good person to ask because you spent quite a bit of time in the emerging market world.
I've traded LATAM. I know a lot of LATAM guys who made a fortune in hedge funds, way more than me. So maybe we should ask those guys. But I don't think, I think most of it's reasonably cheap. I think even Mexico is reasonably cheap. Mexico is a great way of washing Chinese production into US markets. So it's hard for me to feel negative about it. There's restructured. Look, the reason I bought Argentina is not because I'm such a huge fan of Argentina, but because I'm so old that I've seen multiple restructurings of sovereign debt. And when they restructure sovereign debt, you usually get 5 to 6 years before the next default. So when you buy paper at 25% with 25% yields, it'll probably double before the guys get round to defaulting again. That's just how these cycles work.
That's what experience gets you.
If the place that I'm kind of really interested in, the thing that really interests me at the moment, and maybe I'm weird. Actually, let me rephrase that. I'm definitely weird.
I'm going to have something in my mind that I think you're going to say, but I'll say if I was wrong.
Is the Russia-Ukraine situation?
Okay, I was totally wrong.
I think that sometime, and part of this is because I feel like more at liberty to speak my mind, and that this is a contentious issue. But I think we're probably going to have a negotiated settlement that sometime in 2025. And when that negotiated settlement happens, that will be one of the more bullish items for European markets. And it will change a lot of things in European markets and commodity markets. It may well mark the top for commodities because Russia is a huge commodity exporter and we're hampering our ability to go. I'm not saying that's a good thing. I'd hate for people to think that I thought that I had an opinion on the rights and wrongs of the Russia-Ukraine war, but it's an objective reality. And I suspect I was intrigued by a recent video made by Mike Pompeo. Inadvertently, he got pranked, but he was talking to Russian pranksters, and he talked about the fact that we're ultimately strategically going to need to move the Russians onto our side and to break them away from the Chinese because we're going to turn our attention to China.
Wow.
What can I say? Pompeo is not the only person talking like that. And
so would you be so bold to be trying to invest in Russian bonds or Russia?
No, once again, I don't want to go to jail. So if I lived in Dubai and was not a US person, then I probably would buy Russian equities on the back of that kind of logic. Not the bonds, no. Yeah. But if I lived in Dubai, I don't live in Dubai. I live in Andover, Massachusetts, and I really don't want to go to jail. And that kind of transaction will land you in jail. So I don't even think I could do it, actually. But yeah, I can see how Russian assets might be really cheap if we actually come to a deal with them. And that deal, it's a structure of the deal and who's in the driving seat. So it will depend on lots. But I definitely think we want to. What's the funniest thing there? I suspect Putin wants that deal as well, because the internal dynamics in Russia are drifting in the wrong direction from Putin's point of view. They're drifting towards communism again. This whole war thing has revitalized those who are fans of communism. And the national security state in Russia looks to me like an internal battle is forming between Putin and the military factions. And Putin's kind of trying to defend the interests of oligarchs, and the military factions are saying, no, we need to address this problem now and forever. And we have to have a complete victory in Ukraine. Well, I don't think Putin wants them to have a complete victory in Ukraine. So anyway, I know that's a really out there view to have.
Harry, this is what I asked you to do, is come up with some stuff that's worth thinking about and cut through the noise and, put some items on our radar. And you did just that. And you're going to be doing it a little bit more. Are you jumping on Substack soon? I heard a rumor.
It occurred to me that I should state, look, I think we live in there's a joke about the Chinese proverb about a curse is you live in interesting times.
Yes.
I think we live in very interesting times. And I think there's a real upside to writing what I think is happening and finding out whether people think I'm as mad as my wife does. So I'm sort of curious. I want to be nice to have that dialogue. And to write more and see what people think. And, I'm getting on a bit. It's probably about time to branch out and do my own thing a little bit.
I love it. Well, Harry, we always, and I email you and always lean on you for not only your really, really deep understanding of financial markets, because you do, based on all of your experience, even the really technical wonky stuff, that's tough for some of us.
That's my favorite stuff.
I know it is. That's why time for the tinfoil hat. That's why we love it. But also you're really not afraid to be contrarian. And I think that's really necessary, to be thinking out 2 or 3 moves and thinking about what happens if everyone's wrong, or what are the possibilities. There's a lot of sort of easy short-term thinking. That longer term or provocative thinking is really necessary and really useful for all of us. And I know we certainly enjoyed it today. So thank you. And I look forward to seeing you on Substack. We're there too.
Maggie, I really am afraid to be contrarian, but I think there's an age you get to where you're meant to stop being afraid and just say what you think.
I don't believe you are afraid, Harry. I'm not buying that. I think there's a part of you that loves it, I think.
Well, I'd like to say controversial things, but I'd like to also be right. It's often difficult to marry the two.
Just because you're being contrarian doesn't mean you're not right. We know that that's the case. I know that's the case with you, Harry. So listen, fantastic stuff. You'll keep us posted on where to find it and what you're going to name it and all of that kind of good stuff. And then hopefully you'll come back on again and let's continue this kind of conversation. I love it. You gave us a lot to think about heading into the weekend.
And thanks for having me on, Maggie. It was a pleasure.
Fantastic. Thanks to all of you. The chat has been great. We totally appreciate your support and you rolling up here, and you've got a lot of interesting trades on too. So if you're not part of the chat, get in there. These people are awesome. Have a fantastic weekend. And once again, Christopher, happy birthday. Enjoy your day. We'll see you all next week. I've got Jim Bianco on Monday, so that should be very interesting. So join us for that. In the meantime, everybody, take care and good luck out there.